Good morning, dear students. Today I am going to discuss the Dissolution of Partnership Part 2. And here I will start from the accounting treatment. Now, in this case, we have to close our books of accounts. So, we have to prepare an account, that is realization account. So, first entry is we have to transfer all the assets to realization account. So, entry will be realization account debited, to debtors account, to stock, to land and building, furniture, plant and machinery, bill receivable account, all the accounts but at their book values. As you all know that various accounts have debit balance, and now if I am closing the accounts of various assets, then realization account will be debited and assets account will be credited. And on the other side, look at the notes. Number 1, balance of cash and bank should not be transferred to realization account. The assets against which a provision has been created, like provision for bad debts, provision for depreciation, then asset will be transferred on the debit side of realization account at gross figure, and the respective provision will be transferred to the credit side of realization account. Balance of fictitious assets like profit and loss account and any type of like advertisement suspense account is there, that should not be transferred to realization account. Similarly, if there is any debit balance of partner's capital account or current account, this should not be transferred to realization account. Next, transfer of outside liabilities and provisions against asset to realization account. Now all the liabilities and provisions have credit balance, like provision for bad debts. So all these liabilities and provisions will be debited and it will be transferred to the realization account. So look at the entry. Sundry creditors account debited, bills payable account debited, bank loan debited, partner's wife loan account debited. So all should be debited to realization account. Next, note. Again, same. On the liability side of balance sheet, there is capital account, current account, partner's loan account, some reserve might be there. That should not be transferred to the realization account. Next, sale of assets. Now, if we are going to sell any asset, then the cash will be received. So, cash account debited or bank account debited to realization. Why I have credited realization? Because we have already closed all the assets account by transferring them to realization account. Similarly, if an asset is taken over a partner, then the partner is the receiver. So partner's capital account debited to realization account. Next, payment of outside liabilities. We are paying something, so realization account debited to bank account. If any outside liability is taken over and will be discharged by the partner himself, so in that case, realization will be debited, but we will credit the partner's capital account. Next, payment of realization expenses. In this case, there can be three cases. Number 1, when realization expenses are paid by the firm. Entries, realization account debited to bank. Number 2, when it is to be paid by the partner, then realization account debited to partner's capital account. And third case is when realization expenses are to be borne by the partner, means it is the duty of the partner to pay these expenses, but for the time being it is being paid by the firm. So in this case, the firm is paying the expenses on the behalf of the partner. So entry will be partner's capital account debited to bank account. Next, now sometimes the partner may ask for a commission for realizing assets. In that case, if any commission is payable, it is an expense. So realization account debited to partner's capital account. Credit the receiver. So his capital account will be credited. Next, closing the realization account. In case there is a profit in realization account, then it will be credited to partner's capital account. So realization account debited to partner's capital account. And in case of loss, the entry will be reversed. Payment of partner's loan. Now, when I have transferred the liabilities to realization account, at that time, partner's wife loan was transferred to realization account, but partner's loan was not transferred. So for that, we will make a separate entry. So partner's loan account debited to bank. Now all the accumulated losses will be transferred to partners capital account. Losses have debit balance, so now the losses will be credited and partners capital account will be debited. So partners capital account debited to profit and loss account and to deferred revenue account. Next, transfer of accumulated profits and reserves. The reserves and profits will be debited, so profit account debited, reserves account debited to partners capital account. Next, if there is any current account balance of any current account, that will be transferred. In case there is a debit balance in the current account, so current account will be credited. So partners capital account debited to current account, and if there is a credit balance, so now current account have to be closed, so that will be debited. So partners current account debited to partners capital account. Now final settlement. If there is a credit balance in partners capital account, means the firm will pay him. So partners capital account to cash, and if there is a debit balance, means the partner will pay to the firm. So bank account debited to partners capital account. Next, realization account. Now the dissolution of firm means we have to realize all the asset and we have to settle all the liabilities. So for this purpose, realization account will be prepared, and in this case we will close, number one, we will close all the assets and liabilities in this account, and at the end we will find out the profit or loss, which will be divided among the partners. Look here, the pro forma of realization account. Here is the pro forma. Debit side pay, we have on the debit side there are two assets, all the assets. On the credit side there are liabilities and provisions. So if any liability has been paid, we have made two cash account or two bank account, two cash or bank for realization expenses, two partners capital account if they have any taken over any liability, two partners capital account if realization expenses have been paid, and then the profit. Clear? Same on the credit side, buy liabilities, buy reserves, then buy cash for the assets realized, buy partners capital account if they have taken over any asset, and buy loss. Difference between revaluation account and realization account. First, meaning revaluation account records only the changes which have occurred in the value of assets and liabilities, whereas realization account records the sale of assets and settlement of liabilities. Time of preparation. Revaluation account is prepared a number of times, like at the admission of a partner, retirement of a partner, death of a partner, but realization account is prepared at the time of dissolution of partnership firm. Objective. The purpose of preparing revaluation account is to determine the profit or loss on the revaluation of assets and liabilities, and realization account is prepared to determine the profit or loss on the realization of assets and settlement of liabilities. Closure of ledger accounts. Revaluation does not involve closure of ledger accounts, but realization involve closure of all the ledger accounts. Scope. Revaluation account contains only those assets whose or liabilities whose values have been changed, but realization account records all assets and liabilities. Transfer of net result. The profit or loss on revaluation is transferred to old partners in old ratio, but profit or loss of realization account is transferred to all the partners in their profit sharing ratio. Number of times. Revaluation account can be prepared a number of times in number of situations, but realization account is prepared only once, that is on the dissolution of the firm. Next, settlement of firm's liabilities through the transfer of firm's asset. If the asset, whether recorded or unrecorded, are given away to any of the creditor. For example, there is a creditor to whom we have to pay rupees 6,000, and there is an asset whose value is rupees 5,000, and we have transferred that asset to the creditor in full settlement, then no entry will be made. And if we have transferred the asset only for 5,000, then we have to make entry only for the balance 1,000, and that entry will be realization account debited to cash account. So the actual amount paid to the creditor after adjusting the agreed value of asset given away is recorded. And if the asset has been given for full settlement, then no entry will be passed. Treatment of unrecorded assets and liabilities. Now, many times there are some assets and liabilities which are not recorded in the books of dissolved firm, since they are not appearing in the balance sheet. Hence, same will not be transferred to realization. However, at the time of dissolution, when such type of unrecorded assets are sold or liabilities are paid, the following entry will be made. On the sale of assets, cash account debited to realization. If that asset has been taken over by the partner, then partner's capital account debited to realization. Similarly, when liability is paid, unrecorded liability, realization to bank, and if any partner agree to pay off that liability, then realization account debited to partner's capital account. Next, dissolution of a firm before the expiry of a fixed term. Section 51 of Indian Partnership Act 1932 states that when a partner has paid a goodwill on entering into the partnership on a condition that the firm would exist for a fixed period and the firm is dissolved before the expiry of that fixed period, then such partner is eligible to claim the refund of the proportionate amount of the premium of the goodwill, and it shall be debited to other partners in the ratio in which they have received that premium, that is in their sacrificing ratio. The entry will be remaining partner's capital account debited in sacrifice to concerned partner. So he will get that amount of premium which is equivalent to the unexpired period for which he has paid that amount. However, the amount of unexpired benefit of goodwill will not be paid to that partner, number one, if the firm is dissolved on account of death of a partner, because there is no control on that. Number two, the firm is dissolved mainly due to the misconduct of that partner who is claiming the refund. So again, it is his fault, so he will not claim any refund. And third, when the firm is dissolved by the mutual agreement of all partners, again, he will not be able to claim the refund. Next, insolvency of partners. At the time of dissolution, the capital account of a partner may show a debit balance after his share of realization profit or loss and accumulated profits and losses, etc. have been transferred to his capital account. So in this case, he has to bring in necessary cash to make up the deficiency in his capital account. Means if there is any debit, after making all the adjustments, the partner will bring cash in order to make up that deficiency. Number two, if he is unable to contribute fully or partially the debit balance appearing in his capital account, like if it has a debit balance of, say, rupees 30,000, he is not able to bring fully or partially, then that partner is known as insolvent. In this case, the solvent partners have to bear the capital deficiency of the insolvent partner in a ratio which has been mentioned in the partnership deed. In case if there is no ratio has been mentioned in the partnership deed, then the rule of Garner versus Murray will apply. Now, what is the Garner versus Murray decision? There was a dispute between the solvent partners regarding the method of sharing the loss due to the insolvency of one partner. And what was the decision? Number one, the solvent partners should bring in cash their share of realization loss. Solvent partners will bring their share of realization loss. And second, the loss due to insolvency of a partner, that would also be borne by the solvent partners. In which ratio? In proportion to their last agreed capital. Now, how to find out this capital ratio? Number one, if the partner's capital is fixed, then there is no problem. The original fixed capital of solvent partner will be considered to find out the capital ratio. If the partner's capital is fluctuating, in this case, the deficiency of the insolvent partner is to be borne by the solvent partners in the ratio of their capital after making adjustment in respect of reserves, profit and loss account, drawings, interest on capital, interest on drawings, but students make it a point, but before making adjustment of profit or loss on realization, you will prepare capital accounts, you will make all the adjustment except the profit or loss on realization, and then you will find out their capital. Then you have to find out the ratio. So in this ratio, the solvent partners will bear the loss of the deficiency of insolvent partner. Note, this rule is applicable only when there is no agreement between the partners, means nothing is mentioned in the partnership deed. Further, a solvent partner having a debit balance in capital account will not share any loss. So if a solvent partner is having a debit balance, he will not share any loss due to the insolvency of a partner. Now, what happens when there is insolvency of a firm or when all the partners are insolvent? So there is a change in the accounting treatment in this case. Number one, the assets are to be transferred to realization account in usual manner, the way you have done in the simple realization. Number two, accounts of liabilities are not to be transferred. It will not be transferred to realization account. Third, the amount realized from the sale of asset is to be debited to cash and credited to realization. Same entry, cash account debited to realization. Expenses on realization will be debited to realization account, that is realization to cash. The balance of realization account, which will represent either loss on realization, it will be transferred to partners capital account. Then if any cash is contributed by the partners, we will make an entry, cash account debited to partners capital account. Now, the amount of cash available, whatever amount is available with the cash, it will be paid to the creditors ratably. Ratably means proportionately. We will find out the proportion of their outstanding amount and the available cash will be paid to the creditors in proportion. The unpaid balance of the creditors and the outside liabilities. Now, there may be instances in which, yes, there will be instances in which the creditors will not be paid off fully or liabilities are remaining unpaid. In that case, that balance will be transferred to a new account that is known as deficiency account. Again, balance in partners capital account, including the partners loan account, that will also be transferred to deficiency account. Thank you.